Imagine this. You've worked for years to buy your home. You've made every mortgage payment on time. You've built your life around the comfort of knowing that your house is yours. But now the math isn't adding up anymore. In Ontario, mortgage delinquencies, those are mortgages where the mortgage payments are more than 90 days late, have surged 71.5% in just 1 year. In British Columbia, they're up over 33%. These aren't random blips on a chart. These are warning flares. Equifax Canada's latest data shows Ontario's delinquencies rate rising from 0.14% to 0.24% in the last 12 months. That might not sound small, but when you're talking about millions of mortgages, that's tens of thousands of households now behind on their payment. And here's the part that should really make you pause. The GTA, one of the most expensive housing markets in the country, is already seeing delinquency rates at 0.39%, well above the national average of 0.19%. In British Columbia, the story is similar. Delinquencies have jumped from 0.13 to 0.18%. And it's not just in rural town. It's hitting Vancouver, where buyers have stretched themselves to the absolute limits just to get into the market. If this feels eerily familiar, it's because we have been here before. The last time Canada saw this kind of jump was during the 2009 financial crisis. But here's the key difference. Back then, the Bank of Canada slashed interest rates to almost nothing, giving homeowners a lifeline. This time, even if rates come down in 2025, they're still going to be double or even triple what many Canadians locked into during the pandemic. And this is where the real danger lies, because this isn't about numbers. This is about households juggling mortgage payments, groceries, car loans, and credit card bills in an economy where the household debt is now $1.85 for every dollar of disposable income. It's about people getting that letter from the bank saying their mortgage is up for renewal and realizing the new payments is hundreds or even thousands of dollars more per month. When that happens, some people cut back on everything else. Vacations, eating out, saving for retirement, but the others, there's simply nothing left to cut. That's when payments get missed. First the credit cards, then the car loans, and eventually the mortgage. And if we start seeing this happen in large numbers, it doesn't just impact those homeowners. It sends shockwaves through the housing market, the job market, and the broader economy. This is why I believe we're not just seeing a blip in the data. We could be watching the early signs of a foreclosure crisis in Canada. And if you think that that's too strong of a word, stick around, because by the end of this video, I'm going to walk you through exactly why this could get much worse. And more importantly, I'm going to give you steps that you can take right now if any of this is hitting close to home. So let's break down why we're seeing these spikes in mortgage delinquencies and why the situation could escalate into a full-blown foreclosure wave. Number one is rate reset shock. For years, Canadians enjoyed some of the lowest interest rates in history. Many locked into a 1.5 or 2% during the pandemic, confident that they would manage their payments for the next 5 years. Now those same mortgages are coming up for renewal, and the new rate, they're sitting around 5%. That's not a small jump. That's thousands of extra dollars a year in payments. Let's put that into perspective. If you bought a $500,000 home in 2020 with a $400,000 mortgage at a 1.8% rate, your monthly payment would have been well below $2,000. Renew that at 5.5% and you're looking at around over $3,000 a month. That's over $12,000 more per year for the exact same house. If you're a variable rate borrower, the shock has already happened. Payments have jumped repeatedly since the Bank of Canada began raising rates in 2020. Some households are paying 40% more now than they were just a few years ago. And the truth is, for many families, that kind of jump is just not sustainable. Number two is job market weakness. Delinquencies don't rise in a vacuum. They're closely tied to the job market. And right now, unemployment in Ontario is hovering between 7 and 8%, the highest we've seen in over a decade. Construction jobs are slowing as new housing starts drop. Retail and hospitality are seeing layoffs. Even white-collar sectors like tech and finance have been hit. If you're already stretched thin on your mortgage, a job loss or even reduced hours can push you over the edge instantly. Number three is the debt spiral. Canada's household debt is now at $1.85 for every dollar of disposable income. That means that we're some of the most indebted households in the developed world. When mortgage payments go up, something has to give. Often it starts with smaller payments. Skipping a credit card bill here, letting a car payment slide there. Once those accounts are in arrears, the financial pressure snowballs. And history tells us when people start missing payments on other debts, the mortgage is usually next. And this isn't isolated. It's happening from Toronto condos to the rural Alberta home. Number 4, external pressures making it worse. Even if you can technically still afford your mortgage, there are other forces that are eating away at your budget. One of the biggest right now, home insurance costs. In some parts of Canada, premiums have jumped 20% in just 2 years. For properties in wildfire-prone or floodplain-prone areas, it's even higher. Some homeowners are now facing a choice: pay for full insurance coverage or make their mortgage payment. And skipping insurance isn't an option. Lenders require it. Then there's inflation. Groceries, gas, utilities are all higher than they were a few years ago. Every dollar going to those costs is a dollar not available for your mortgage. So this leads us to number 5, which is why could this be worse than 2009? Back in 2009, during the global financial crisis, the Bank of Canada slashed interest rates quickly, bringing relief to borrowers. Homeowners could refinance into cheaper loans and then kept many from defaulting. This time, even with more rate cuts expected this year, we're not going back to the pandemic era lows. Analysts expect the Bank of Canada to maybe drop the policy rate to around 2.5%, maybe 3% over the next 2 years. That's still double or triple the rates people had in 2020 and 2021. So even after relief comes, many borrowers will still be paying significantly more than they had planned. Number 5, the perfect storm risk. Here's a scenario that nobody talks about. Rates stay higher than expected. Job losses continue or worsen. Delinquencies rise from 0.24% to 0.5% or more. That's when you start seeing forced sales, not because people want to move, but because they have no other option. And forced sales put a downward pressure on home prices. When prices drop, homeowners who bought at the peak, especially with the small down payment, can slip into negative equity. That means that they owe more than the house is worth. At that point, even selling doesn't resolve the problem. That's when foreclosures really take off. The GTA and Vancouver are epicenters. If we do see this unfold, the Greater Toronto area and the Metro Vancouver area are likely to be the hardest hit. Why? Because they have the highest average mortgage balance in the country, the steepest price run-ups in the last decade, the greatest share of borrowers who stretch to qualify under the old stress test. RBC's data already shows the GTA delinquency rate of 0.39%, more than double some of other regions. That's the canary in the coal mine. And that is extremely concerning. So where does this leave us? We're standing at the intersection of high interest rates, rising unemployment, record debt, and an already expensive housing market. Each of these factors alone is a challenge. Together, they're a recipe for a foreclosure surge we haven't seen in modern Canadian history. And while I'm not saying that this will happen overnight, the data is clear. The cracks are forming, and once enough cracks appear, the dam can break quickly. If you're watching this and thinking, this is hitting close to home, I want to know something. Do you have options? I'm going to give you specific actionable steps you can take right now to protect yourself from being part of these statistics. And some of them might surprise you. Don't wait until it's too late. Just stick with me. All right, we've talked about the warning sign. We've looked at the numbers and we've seen why this time could be worse than the past downturns. But here's the most important part. You're not powerless in this. Even if you're feeling the pressure right now, there's moves that you can take to protect yourself and your home. Get ahead of your renewal. If your mortgage is coming up for renewal in the next 12 months, don't wait for your lender's renewal letter. Shop around. Sometimes moving to a different lender, even if it's a non-bank or credit union, can mean the difference between keeping your payments manageable or falling behind. Number 2, extend your amortization. Yes, you'll pay more interest over the lifespan of your loan, but right now, survival matters more than speed. If you're on a 25-year amortization, consider stretching it back out to 30 years. This can drop your monthly payment by 15 to 20%, giving you breathing room until rates come back down. Step number 3 is consolidate high interest debt. If you have equity, rolling credit card balances, personal loans into your mortgage can cut your monthly payment significantly. The key is discipline, not running those balances back up. Step number 4, cut early and cut deep. If your budget is already tight, make those cuts now. Subscriptions, non-essentials, even downsizing your vehicle. It's easier to adjust voluntarily than to be forced into it later. Step number 5, seek professional help before you miss a payment. Too many people wait until they're already in arrears to ask for help. At that point, some of the best options are off the table. Talk to a mortgage broker or a financial planner early. They can help negotiate, restructure, or connect you with programs that you may not know about. So the headlines might feel overwhelming: rising delinquencies, job losses, rate shock, but foreclosure is not inevitable. The sooner that you take action, the more choices that you'll have. If this resonates with you, start exploring your options today. Protecting your home is protecting your stability, your security, and your future. Book a call with me in the description if you want to discuss further.